I'm Mark Bruno, the Director of Online Content and Data for Investment News, and we're here in Orlando at the 2012 TD Ameritrade Institutional Conference. One of the biggest issues at this conference, what will it take to get advisors and their clients to reconnect with equities again? We talked to a number of top investment minds and a number of top advisors, and here's what they had to say about what it will take to get clients to invest in the equity markets once again.
You know, equity closed-end funds are out of favor, they're super wide, and actually the flows just aren't going there because people are unsure where the markets are going, what's going on, Europe, what's going on there. There's just a ton of uncertainty, and I don't see that going away anytime soon.
He or she has to be convinced, listen, I can build a portfolio where I can get great income that's growing over time. And once I get that income, I don't have to look at the price every single day.
We will see people re-engage, but I do think that one of the big challenges out there is that fixed income will just not provide much of a return after you strip off inflation. The Federal Reserve has said they won't raise interest rates until probably at least the end of 2014, which means that from a valuation point of view, equities are going to end up being the most attractive, even though it probably will be a bumpy ride.
We're starting to see a great deal of interest in dividend and equity income type of strategies. As a matter of fact, the single largest set of inflows in 2011 was to the new iShare that we had launched, HDV, as far as new funds that were launched in 2011.
I'm still recommending, as I did last year, the dividend paying stocks, which did, as we know, extremely well last year. And the advantages there are very, very simple. You're going to get a dividend. You're getting a dividend much better than the interest rate you're getting on alternatives now. And as long as it's well covered, you don't have to worry about the day-to-day fluctuations in the price of the stock.
There's a lot of fear on the horizon of the unknown of what's happening in Europe and the slowdown in China. And what you're seeing is really a continued liquidation out of equity-based positions, and you're seeing advisors continue to use fixed income as a safe haven, which is somewhat problematic considering that they're not getting the yield levels and return levels that are get their clients where they need to be over the long term. So what's encouraging is we're starting to see the adaptation and the utilization of managed futures and currencies.
The paradigm has shifted, and it is going to be more a combination of all the above, as opposed to the more traditional fixed income and equity portfolio with a little bit of REIT sprinkled in. I think you're going to see much more in the alternative investments.
I think that there are ways that investors can invest so they don't have to worry as much about that stock volatility.